2025 results presentation for Caledonia Mining. Today we are joined by Mark Lehrman, who's the CEO, and he is going to introduce the webinar and start his presentation. Mark, over to you.
Yes, Scott. So welcome to the Q2 2025 results presentation for Caledonia. Can you just move on to the forward-looking statement and disclaimer, which I trust you will read and digest. So let's take a bit of time. Okay, let's move forward to the presenting team. As Scott said, I'm Mark Lehrman, Caledonia's CEO. I'm here in Jersey today. I'm joined by Ross Gerrard, our recently joined CFO. He's in Johannesburg and will run us through the financial results. We've got James Mufara, our Chief Operating Officer, who's joining us today from Blanket Mine. Victor Capari in France will briefly update us on the Bilboes project. And Craig, Vice President Technical Services based in Johannesburg, will talk to us briefly about the ongoing exploration at Bilboes and Motapa. And Morris, Vice President Corporate Development and Investor Relations, will deal with any other tricky questions that may arise. So should we just move forwards? Okay, well, look, it was a very strong financial quarter underpinned by excellent production. So the financials were strong, revenue up 30% to 65 million, a net profit attributable to shareholders up by 147% to just over 20 million, and adjusted earnings per share was up by 155%. Underpinning that was some very strong operating cash flows. Operating cash flows rose to 28 million, and we closed the quarter with $8 million of net cash. In addition to that, we had another $18 million of fixed-term deposits. So if you regard fixed-term deposits as cash, which I do, that's about $26 million of cash. From an operating perspective, Blanket Mine had an excellent production quarter, just over 21,000 ounces in the quarter, which is a record for any second quarter. And on the back of that, we've increased full-year guidance to a range of 77,500 to 79,500 ounces. And all of this was really underpinned by a stronger gold price. We realized just under $3,200 an ounce. As you'll be aware, in the quarter, we closed the sale of the solar plant, which realized 22.4 million. I'll be clear, we never intended to own that solar plant. We only had to own it to get it built. And it was always the intention to sell it. Part of the sale is that we've secured a long-term supply contract for Blanket. So we just released the capital for use elsewhere in our core business, which is developing and running gold mines. And as you'll be aware, we've got a very strong growth pipeline. We're continuing at a pace with the Bilboes feasibility study. We're looking at cost-saving options and a phasing approach to try and minimize the upfront capital cost of the project. Victor can update you on that shortly. We've got a $2.8 million exploration program proceeding at Motapa, which is going well. And it's also fair to say that the exploration at Blanket's also going very well. That exploration at Blanket's got two aspects to it. The first is just simply resource replacement. So just making sure that we replace the resources that we're depleting. But also probably with some excitement is new areas within the Blanket lease, which we've never had the money or the management depth to do. And we're now turning our attention to that, and we're getting some quite good results out of that. So just in a bit more detail, just turning on to the next page. James will talk to us about safety and production, but it's pleasing to see an improvement in our safety performance. The total injury frequency rate for the quarter and for the half year has improved. Clearly, there's always further work to do, but it's good to see the general direction of travel is in the right way. James will also talk about production, which I've mentioned. I've mentioned the average gold price. Revenue up from 50 million to 65 for the quarter, up from 88 to 121 million for the half year, and gross profit of 33.8 million for the quarter, which excludes the $8.5 million profit on the sale of solar. So adjusted earnings per share for the quarter were about 114 cents for the quarter. That includes about 44 cents from the profit on the sale of solar. So that equates to about 70 cents from operations, and that compares to approximately 40 cents that we made from operations in the first quarter. So even stripping out the benefit of solar, it's been a very good quarter. Should we just move forwards. And a lot of people, as we look forwards, look at how far we've got to go in terms of climbing the hill to deliver the Bilboes project. It's also worth looking backwards to see how far we've come over the course of the last 10 years. And so all we see here is a 10-year graph from Bloomberg, which shows the gold price, the VanEck GDXJ index, and our share price, including dividend reinvestments. And it shows you that over that 10-year period, the gold price has gone from 100 to just over 300. The GDXJ has gone up from 100 to just over 400, and Caledonia mining has gone from 100 to over 1,000. So it's a great performance over the last 10 years. But during that period, all we've done is take Blanket from about sort of 40,000 ounces to 80,000 ounces. The growth trajectory ahead of us is even more exciting. And I think what underpins our performance over the last 10 years is two things. First of all, minimizing dilution. And that is, we say that in terms of funding Bilboes, our objective is to minimize dilution. We really mean it. I mean, we delivered great returns over the last 10 years by keeping a very tight lid on equity dilution. There's no reason why we're going to depart from that now. And the second is the importance of dividends. Now, clearly, we don't have a dividend policy in terms of a dividend payout, but we really understand the importance of dividends in terms of shareholder returns. And in certain markets, particularly Zimbabwe, which is a good source of equity for us and great support, the dividend is crucial there. So the dividend is again baked into our appreciation of how we run this business. Just moving forwards, I think it's also worth making a few comments about Zimbabwe. Look, we operate in Zimbabwe every day, and when you're so close to the coalface, it's sometimes quite difficult to step back and appreciate what's been going on there. And frankly, over the last 5 years or so, we really have seen some very encouraging signs in Zimbabwe. Physical security, which has never really been an issue in Zimbabwe, remains, but it's become much more of a serious issue in other jurisdictions in Africa. And it's just worth noting that whilst many other places have got worse, Zimbabwe hasn't got worse, and in some respects are getting better. Foreign exchange, the foreign exchange environment in Zim has historically been super turbulent. What we've seen over the last 18 months or so is an increased stability and further moves to liberalize the local market, the local foreign exchange market. Clearly, there's further work to do, but we are seeing increased liquidity for selling the local currency, the ZiG, in the willing buyer, willing seller market, which is good. And we're also seeing more stability in the ZiG dollar exchange rate, which is underpinned by continued financial rectitude on the behalf of the Reserve Bank of Zimbabwe. So long may that continue. We wouldn't have achieved the results we have done without a high quality local workforce. And one of the things that's happened behind the scenes over the course of the last year or so is that we've substantially changed our management team, relocating people or taking people on in Zimbabwe. And we wouldn't have achieved the record production that we did in the second quarter after a very creditable first quarter without high quality local management. And so it goes without saying that that the management team in Zimbabwe really has got experience, they've got quality, and about 50% of the current senior management team at Blanket, about the top 25 senior managers, of those top 25, about half of them have been with us for a year or less. Clearly, there's an electricity problem in Zimbabwe. It produces less electricity than it needs, but the government over the course of the last few years has taken several initiatives to try and ameliorate that situation for people like for big users like Caledonia, or Blanket. We're a member of what's called the Intensive Energy User Group, which means that we can import power from the South African power pool or the Southern African power pool, where there was no shortage of power availability, so we can actually import that. And it's also fair to point out that the Zimbabwean authorities have been very quick to fast track the permitting for independent power projects, be they solar or standalone coal-fired power stations. I think all of that's reflected in Zimbabwe's ranking in the Fraser Institute survey, which was published recently. And that showed that Zimbabwe's come up from the absolute bottom of the table, and it now ranks 8th out of the 17 African countries which are covered by the survey. So we are seeing encouraging signs in Zimbabwe, and we hope that those signs that progress continues. So with those introductory comments, I'll hand over now to Ross, who will run us through the financials. So Ross, over to you.
Thank you, Mark, and good afternoon, everyone. It's my absolute pleasure to talk you through the financial results for this quarter, and reiterating what Mark said, it was another excellent quarter. So if we can turn to the next slide, please. Just talking through some of the headline numbers that were referred to. Gold revenue was up at 65.3 million, which was up some 30% on the comparative quarter. This was driven by that good gold production, up at 21,000 ounces, in addition to the benefit of a really good realized gold price of $3,186 per ounce, which was up some 38% on the comparative quarter of 2024. This obviously meant that there was a higher royalty during the period that you'll see on the right-hand side of the table. And importantly, the delivery of those ounces, which was really driven by higher grades and plant recoveries, and James will talk to those a little bit later in the presentation, but that did drive our production costs, which were up some 18% for the quarter. We will do a bit of a deeper dive into those production costs in a moment, but the end result to the high level was that gross profit number of $33.8 million for the quarter, which was up 48% and another quarterly record. So a fantastic result. If we turn to the next slide, we'll just talk about that gross profit. I love the slide, and it's a very simple slide with a great trajectory, but the two key messages to take away is the change in bilbos and the fact that it's no longer having a negative impact. So that's indicated by the orange line. And importantly, the trajectory of Blanket, where you see that significant increase in profit, all heading on in the right direction, and I guess we've got to keep that trajectory going. So really great delivery across the year, and looking forward in terms of a gross profit profile. But if we turn to the next slide, we'll do a bit more deeper dive into those costs. And you'll remember from the first quarter result where we spoke around our guidance, where we're sitting from a cost perspective slightly above our guidance range. You can see on the left-hand side, we're now bringing that back within range, albeit still at the top end of the range. So costs are very much still part of our focus, and we've got a number of key initiatives that we've got in play that will address that. And overall, we believe that the full year guidance range is still on track and will be achieved. But you'll see that the three key pillars of our cost base in terms of labor, consumables, and power indicated in those slides. I guess from a labor perspective, the key changes are really around the payments of higher production bonuses. So a key component of that labor cost was a almost $2 million cost that went through in terms of bonuses, overtime, and holiday pay, is really around delivering those tons, but also addressing certain breakdowns during the period that we had to address, and well done to the team to get on top of that. Consumables was really above budget by around $3 million. And a large portion of that was around those ZIG purchases, where we've spoken about mobilization of ZIG purchasing items like lime, mill bores, some construction materials. So there was about $1 million that we spent in terms of accessing the willing buyer, willing seller market there, but also some overruns in terms of spend in terms of our TMMs, and also some of the engineering and repairs and maintenance and electrical engineering works that sat within that consumables bucket. This was partially offset by the power savings that you see in the lighter blue column there. And again, credit to the team. This is a key initiative that we've articulated very clearly in terms of having a stated objective or a project in terms of addressing a certain area. And you can see the benefits of some of those power savings coming through. Well done again in terms of a key delivery. Moving to the right in terms of what it means for our all-in sustaining capex. The on-mine costs that we've just spoken about, they've flow through. So you'll see a 7.4% increase in terms of comparative quarter there. But the big bucket was that sustaining CapEx bucket. And again, that CapEx spend is on track for our full year guidance. Traditionally, our second and third quarter are bigger quarters in terms of spending from a CapEx profile perspective. It's probably fair to say that the previous quarter, in terms of comparing to this time last year, was probably on the lower side, just because of funding constraints. But I guess the overarching message here is our CapEx profile is on track. We're spending it in the right buckets, and we believe that full year guidance profile will be met. So great performance in terms of our individual cost profiles. And if we move to the next slide, we'll look at some of those costs below the gross profit line. That net foreign exchange loss line item, that's obviously a big area of constant focus for us. We are managing to deploy our ZiG balances, and a key position in that is being able to access that willing buyer, willing seller market. That run rate is lower than the comparative quarter. You'll see that that's dropped, and that is a combination of both realized and unrealized losses. So it's about a 1/3, 2/3 split in terms of the full 6-month period. But we're pleasantly pleased with the result in terms of where we sit for the half year, but it is an area of constant focus in terms of deployment and managing our exchange risks. The corporate line item that you see there, a lot of that includes some one-off costs in terms of restructuring that Mark had alluded to, that has come through in that first half, but also some additional equity share-based payments expenses that have come through, and that's just based on the metrics and the performance to date. The big items are the sale of the solar and the profit coming through. So you'll see 8.5 million as an individual line item coming through, and then equally down at the tax expense line, the good performance, the good revenues and activity that's occurred has obviously resulted in a higher tax expense. But we've also included the tax on the solar sale in that line item. And whilst that number has increased, I think it's very important that, paying our way and paying tax is very important. So it's a pleasing result in terms of good performance, and actually across both royalties, taxes paid, and tariffs, we're certainly a major contributor in terms of Zimbabwean economy and paying our government share, our fair share to government. So it's a pleasing result. But overall, a great performance, ending with a profit for the period of $23.6 million. And you'll see the earnings per share there of 113.9 cents per share. And adjusting for the solar, as Mark had indicated, you'd back out approximately 44 cents from that. So comparing just shy of 45 cents for the comparative quarter against 70 cents for this quarter. It's a great step up in terms of performance. So if we can move to the next slide, we'll talk a little bit more about the cash flow. Our cash flow from operations is, we've really done well. We've generated some strong cash. There has been the net increase in the working capital. There's been that deliberate increase in working capital, particularly around stores and prepayments, where we've deployed and tried to use our ZiG balances and have local purchases. There are some changes in that net line in terms of timings of shipments of payments and receipts, but overall, there's a deliberate position in terms of working capital to make sure that we can be robust with our operations. But the key areas that I want to speak about are our capital expenditure. So you'll see, from that operating activities or cash generation, we've been able to deploy our funds across investing in our capital expenditure. So some almost 21 million for the 6 months in terms of capital expenditure. We've received proceeds from our sale of our solar of 22 million, and equally we've been able to deploy those funds into fixed term deposits and some derivatives. So it's been a very solid quarter, and in fact 6 months in terms of both generating cash and closing the period with some $8.2 million of cash, with that further 18 million sitting in terms of deposits. So effectively a $26.2 million cash balance. So if we move to the next slide, you'll see the breakdown of that 26.2 million on the right-hand side of the slide, both in terms of where that cash sits across the various jurisdictions, but importantly, the build across the comparative periods in terms of our trajectory in terms of treasury and cash. I would highlight that the balance, the 4 million sitting in Zimbabwe, that's abnormally high. It was really around timing and deployment of funds. So it was really timing of that. But overall, the 26 million, and actually, if you exclude the overdraft facilities, so on a gross basis, we actually just shy of 40 million in terms of cash balances. And post the half-year result, we've been able to continue to build that 26 million up to 30 million in terms of our pro forma net cash position on basically this last week's cash balance position. The graph there shows that build-up of cash, so it's very important. And I think the key thing or key takeaway is that we're trying to build that cash balance to a $50 million plus number by the end of the year in terms of really having a solid treasury position. We move to the next slide. The one thing that we would like to highlight, and you'll see in the published results, is that we will be taking advantage of some applicable exemptions. So in terms of our quarterly reporting, we'll be following a reduced disclosure regime or reporting disclosure. So for both the first quarter and third quarter going forward, we will have a much reduced financial, both MD&A and financial set of results coming out. We are fully committed to our transparent and timely disclosure, so we'll give you all the material information and select financial results coming through, but you won't see the full set of MD&A financials that you've historically seen. That is only for first and third quarter. For the full year and obviously half year, it'll be part of the normal cadence, and you'll get the full deep dive and narrative that's going forward. So with that, a very solid quarter and half year, and I think we're well set to enter the second half of the year and deliver on continued good performance. And with that, I'll hand over to James Mufara, our COO.
Thank you very much, Rose. Thank you very much, Mark, for the opening remarks as well. Good afternoon to you all. If we can move to the next slide. As Mark and Rose have already alluded to, we have had a very good and solid half year, and this quarter was particularly very good. We brought to the market earlier that we had a very, very stringent look at our health and safety programs on the mine as part of our value of care. And we've always said we would want to improve in terms of our performance thereof. Quarter two delivered a marked improvement from quarter one in terms of our health and safety criteria that we're looking at. The number of accident-free days actually increased in the quarter from 83 to 85. And the total injuries themselves actually reduced. The lost time injuries went down as well from 4 to 1. And the significance of the lost time is showing the severity of the accidents that we are having. They are of low energy accidents that we're actually having and witnessing. In the quarter, we also had quite a number of bow ties that we actually completed so that we could look at all the significant and wanted events that we want to deal with, and 52 of them were actually completed in the quarter. As part of our culture journey to see that employees work safer and better with time at Blanket Mine, we started to profile our employees for risk propensity, which is their propensity to take risks. And we started with the supervisors and we will look at this journey going forward, so as to look at continuing to improve health and safety. But as we would appreciate, health and safety is like sweeping water uphill. You need to be constantly at it. If you stop, it will come back to you. So keep obviously our eyes open with regards to health and safety issues. If you may go to the next slide, please. So in terms of the grade and the tons, which is our traditional reporting line, you would see that the orange line is the grade, and the blue, the top line, the dark blue line represents the tonnage. We're pleased to report that we had a record production in terms of tons that were milled. We actually ended up on 204,915 tons for the quarter, against a plan of 193,000, which is actually 6%, 11,000 tons, or 6% above what we set as the plan. We also realized that in this quarter, we actually had a welcome improvement in the grade from the last quarter, ending up above plan at 3.31 grams per ton, representing a 3% better than the plan. This was a welcome, improvement, and it's a result of our continued focus on the increase in flexibility and our look at the development that we've been increasing over the years. In terms of the bottom graph, which actually represents the ounces and the recovery, you will see that we produced the record ounces that Mark alluded to, which is a record production for any second quarter. And that was underpinned by, a record recovery of 94.41%. We've actually managed to get to this number by 3 key initiatives that we actually introduced in the quarter. The first one was the introduction of tank number 9 to optimize the residence time so that we could actually recover better. The second one was to look at reagent dosage and optimize that so that we could have efficient leaching and efficient adsorption. We also started to have enhanced process control through short interval controls with the new management team that we've actually put at the plant. All these initiatives resulted in a record Q2 production in terms of ounces, as alluded by Mark earlier. If you may turn to the next graph, please. So this graph shows how we actually achieved the ounces, that this was not a once-off haul. This was not that we did right at the end of the quarter. It was we produced consistently throughout the quarter, feeding the plant with consistent grade and consistent tons, and thereby producing the record production. You can see that the top line, the orange line, is the cumulative, the adjusting, what we actually did, and the bottom line, or the line which is deeper purple, is actually the line for the budget. You can see that from the first month, which is the April month, we actually, while we had a budget of 5,818 ounces, we already superseded that. We continued at a steady rate throughout the whole quarter, ending up on 21,070 ounces. This supersedes the Q2 ounces for last year, which were sitting on 20,774 ounces, and also better than the same Q2 ounces for 2023, which were sitting on 70,400 ounces. So this is really, really a record production, and done the right way consistently throughout the quarter. We may turn to the next graph, please. So this is a very nice graph, which actually points out to how well the team is doing all around. So it's, while the team has actually achieved record production ounces, they have also done it in a very responsible way. You can see that in terms of reserve generation, we actually added reserves in terms of the reserves that we actually generated. This is as a result of better development, which was done by the team. I mean, thanks to Elton and Newton for doing this massive development being over their development targets over the quarter. And this is a result actually in us putting back some reserves back into the iceberg. If we may go to the next graph, please. Thank you. I will hand over to Victor.
Thank you. Thank you, James. Thank you, Mark. Can we move to the next slide, please? What we would like to do today is to update you on where we are with the Bilboes feasibility study. The work on the Bilboes feasibility study is continuing at a very satisfactory pace. The work has confirmed that the project has robust economics with a high debt capacity. The main areas which we have been evaluating include consideration of moving the tailing storage facility to the Motapa property, which is just next door to the Bilboes property. Really, the benefit of this would be lower construction costs because of the topography. Whereas at Bilboes, it's rather a flat piece of land where we would need to put the tailings facility. At Motapa will benefit from the topography, so it will reduce the earthworks which we have to do there. The other consideration which we have been looking at is really looking at a phased approach to the project, starting at a smaller level, at a smaller scale level, and then ramping up to full capacity. This really looks at the issues of financial prudence at the end of the day, just to make sure the amount of capital we are raising is not excessive. We've also been exploring short-term revenue opportunities across our asset portfolio. This would actually help in terms of the financing of the project. With regards to the funding, as usual, our aims.
We seem to have lost Victor.
Yeah, we seem to have just a minor issue on Victor's. Mark, maybe if I could ask you just to continue whilst Victor's signing.
Yeah, I don't know if Victor can hear me, but Victor, I think we should put Victor on mute because he's lost his linkage. Yeah, so as Victor was saying, in terms of funding, our aims, we've said this before, but we mean it, is to maximize net present value per share, and that is balancing growth and minimizing equity dilution. And that's why I started off with that graph, which shows the extent to which we've outperformed the GDXJ. That's largely because we've not diluted shareholders, and that's in our DNA. So Victor said that the reason we're looking for a smaller scale phased approach is to minimize the amount of debt we take on and hopefully to avoid completely any equity dilution, but with a prudent level of gearing. So in terms of the funding options we're looking at, the non-equity funding options, we're looking at non-recourse project finance, and there's a handful of African development finance funders who've expressed interest. We're looking at a modest amount of mezzanine funding on the basis that it is substantially cheaper than our cost of equity, and also asset-backed loans. So the final funding decision will clearly follow the feasibility study and will depend on funder timelines. Some of these funders may not be quick, but we'll do the best we can. So I think that's probably the best update I can give on Bilboes. Sorry, Victor, if you can, we just lost you partway through. I don't know if you can hear me.
Yeah, now I can hear you. Can you hear me now?
Yeah, but we just finished. We just finished your section.
Yeah, okay.
It's that
So,
filthy French,
yeah, I could hear you at the end.
That filthy French Wi-Fi connection you've got. Sorry. Should we move on and talk about
Move on to the next?
Yeah. Craig?
Okay, I'll hand over to Craig, who will take us through the Motapa exploration.
Thank you, thank you, Victor. Thank you, everybody. Good afternoon. Just while we're on the slide, I just want to touch briefly on Blanket for people that are not aware. On the 23rd of June, we published a Blanket deep drilling press release. So that's why there's not much about Blanket actually in here. continue with our deep drilling program. We continue to get expected grades, in some cases much better. Carrying on with the widths and the whole intention is to maintain our resource base at kind of the 3 million ounces, which delivers a mining reserve plan of about 10 years. So that's kind of what that drilling is focused on. The CEO alluded to the fact that we're also looking at other opportunities. I haven't got results to share with anybody, but one thing that I want to leave in people's minds is that if you visit the Blanket property, the one thing that you won't see at Blanket is an open pit. If you go visit a number of other mining properties in Zimbabwe, well, guess what? They all started off with open pits and progressed underground. So if we can go on to Motapa, if we can go to the next slide. A reminder of what we are doing for the year. So we have a $2.8 million budget for the year. It's mainly comprised of about 21,000 meters of reverse circulation drilling and just over 1,000 meters of diamond drilling. And why that weight is like that is that the previous year it was about 50-50 of diamond drilling versus reverse circulation. We now have, we feel, enough information on the geology to actually put the weight of the drilling into reverse circulation. The targets are Motapa North, and it's predominantly to define a sulfide resource below historical oxide pits. There's about 16,000 meters of drilling there in total. A second target is Mapudzi. The intention there is to have a look at predominantly the oxides going into the upper sulfides. And why this is the case is simply at Mapudzi, there's no historical open pits on site. So we do believe that if all the work is done and it is amenable to heap leaching, that the potential is there to define an oxide mineral resource that can come onto our books in the near future. A little bit of further exploration at Motapa South, and to date we have drilled about 50% of our budget. We're just under 10,000 meters. All of this drilling will be updated once we have sufficient assays coming in. So although we've drilled about 50% of our budget, from the assays that we've submitted to the local labs, the Zimbabwe labs, accredited labs, we've only received about 40% of those assays back. And so, I mean, it's very frustrating for us, but in kind of a Zimbabwean context, it's actually very encouraging. The reason for the slow turnaround is it's not just us that are submitting hundreds of samples. There's a number of other companies that are on the scene and quite clearly in this higher gold price environment have pulled the trigger on exploration, which I think bodes well for Zimbabwe. I think it's completely underexplored, maybe not well understood, but there's significant potential for the country. If we can just go on to the next slide, it's just a brief overview of Motapa North. It's made up of those open pits that you see, the Pluvius pits, the Boomgate, Jupiter, and Shawl. The blue line boundary, or the blue line that you see there, is the Bilboes property to the north. It's about 200 meters away. All the red dots is all of the first pass drilling we did during 2024, and all of the yellow dots represent the drilling that we have done and completed to date. So there'll be about 50% more of those dots. The targeted aim here, and so as I said, so as we receive the assays in and we have a bulk of results that we can release, we will put out an update. But the main goal is by year end, we want to have defined a sulfide mineral resource that we can declare and we can move into quite probably a study phase. If we go on to the next slide, which shows the Mpudzi area. So the picture's a bit blurry. The Google Earth is not very good on that imagery. But you can see there's no open pit mines or open pit holes. Once again, all of the red is what was the first pass drilling in 2024, a bit of wider space drilling. All of the yellow is what we've done to date. And Mpudzi is slightly different to the other Motapa areas because it's focused mainly on a banded iron formation. It's got a bit of shearing. We're getting some good grades, we're getting some good widths, but we'll update the market on that as we go forward. So with that, I'll hand back over to Mark for any closing comments.
Good, thank you, Craig. Should we just move to the last page? Okay. So in terms of outlook, the objective of Blanket is to achieve the target range of 75,500 to just under 80,000 ounces. Keep doing the investment to modernise and update the mine, with an increasing focus on cost containment and eventually cost reduction. Continue with the investment at Blanket to do, as Craig outlined, depletion replacement, but also looking at Blanket at potential for near-term revenue opportunities. We'll continue looking at continue the work on the feasibility study at Bilboes, looking at ways to look. The project's a great project, just looking at ways to make it better. And typically in Zim, we've always had to battle against bad things that have caught us sort of unexpectedly. I think in this situation, we're actually trying to make the best of good things. So build on good things that are happening for the benefit of investors. And then clearly, as Craig outlined, continue exploring at Motapa, looking at oxides and sulfides. So, you know, there's a lot happening. And I've got to say, these results give a very, very nice sort of launching pad for further activity. So with that, we'll pause for any further questions.
Thanks very much. If people who would like to ask a question, if I could ask them to please raise their hand. We'll just pause for a few seconds to wait for people to raise their hands in order to ask a question. We're going to start with our first question, which is from Ian Jocelyn. Ian, I'm going to enable you to talk. Ian, if you could please ask your question when you're ready.
Can you hear me?
Yep.
Okay, good. My question related to well, the fact that you're generating large amounts of cash, your performance last quarter is to be commended. I also like the idea of you're trying to improve on the joint Bilboes Motapa project. You're trying to find ways of making it return greater return on a given capital. And I also like the idea of you being totally anti-dilution. I'm absolutely in favor of that. So obviously there's an old equation. The more equity you have to put into a project, or the more cash you've got to put into a project, the less you get shafted by various financial institutions. So if it comes to it, and you're getting close to pulling the trigger on the project, what would your view be on suspending dividends in order to ensure that you had more cash to offer the project, and therefore had to borrow less, and therefore had to, or even raise equity less, and therefore not get future profits expropriated by institutional organisations?
I'm going to say you've got a very jaundiced and jaded view about the investor community, but we'll put that on one side.
40 years experience.
Well, yeah, okay. The dividend, as I outlined at the outset, the dividend is very, very important, particularly in Zimbabwe. And you're right. I mean, purely objectively, if we were short of money and had to raise money, the obvious thing to do would be to suspend or cut the dividend. I've got to tell you, we're working towards an outcome where we can not dilute by raising equity. Now that's still a work in progress. But the other imponderable would be the adverse effect on the share price if we did cut the dividend or impair the dividend. Frankly, you don't know what that impairment would be until you've done it, by which time it's too late. So all I can say to you is that we've worked for, I don't know, 10 years or so to build up a position as a trustworthy, credible dividend payer. And everything you say is right, but for us to throw that away would be unfortunate. So I can't give you a straight answer to that question. Minimizing equity dilution alongside maintaining the dividend and eventually growing the dividend, they're two irreconcilables, but our job is to try and reconcile them. That's all I can say.
No, my main point wasn't that you should do it, but that you would be, what's the word? You're clearly open to the idea, and I fully understand and I accept that there could be an adverse share price movement, although it wouldn't be rational because you'd be using the foregone dividend, hopefully, into a project that would yield greater returns.
The difficulty with this conversation is that people may walk away from this conversation feeling that I'm hinting that we're going to cut the dividend or curtail the dividend. I'm absolutely not saying that. The other side of the coin is we never give a dividend guarantee. If you want a guaranteed revenue stream, go and buy a Swiss bond. So I'm trying to navigate between those two, the Scylla and shrewdness of those two outcomes, and I'm not altogether sure I'm doing a great job of it. But the dividend is super important to us as a management tool. We know it's important to certain of our target markets, and that's all I can say.
Okay, understood. Thanks.
Thanks very much. We're going to go to our next question, which is from Mike Kozak. Mike, please unmute yourself when you're ready to ask the team a question.
Very, very good. Thanks. Can you guys hear me okay?
Yep.
Yeah. Okay, great. Good afternoon, Mark and teams. Congrats on the very good quarter and the solid cash flow build. It's nice to see. I had two questions on Bilboes. The first one, if you've already answered it, I apologize. But the first one was the feasibility study. Do you have an approximate timeline for when that is going to be completed and released?
Not really, because the ongoing work about the smaller scale option is an indeterminate period of time. So I can't help you on that at this stage, I'm afraid.
Okay, and then my second question, which it was kind of curious to the extent you can comment. You did mention, I know it's scaled down or kind of slight change of scope. What kind of quantum for a reduction in initial capex are we talking? Right, I think the PEA was, 310 million. Is it a number now closer to 200? Is it a 250?
No, I think you've got to accept that if you were to progress with a 240,000 ton a month project, those capital costs will have gone up. Capital costs have gone up across the industry. So again, I can't really give you guidance on that. We've got a number, but I mean, to start dribbling out information piecemeal isn't going to help anybody, because anything I give you is going to be inadequate and you're going to want more. But one of the things that's clear, and you'll understand this, is that the capital intensity of a smaller project is higher than for a bigger project, and that's something we've got to bear in mind. Okay, but the other side of the coin is, what we lose on higher capital intensity, do we gain in respect of reduced financial jeopardy from taking on a high amount of debt and reducing or obviating completely the need for equity dilution? There's a lot of balancing to take place here. That's the problem.
Got it. Okay.
But fundamentally, what we talk, just be clear, we're not talking about how to make this project work. Okay, no, we're talking about how to make this project the best it can be, which is a different thing.
Got it. Okay, I appreciate that color. I'll jump back in queue. Thank you.
Thank you.
Thanks very much. And we're going to take our next question from Howie Flinker. Howie, please go ahead. I'm going to unmute you, ready to ask your question.
You hear me?
Yep.
First, there's a typo.
Yeah. Thank you.
In the printed income statement, the 4 columns say 6 months ended. The 2 left-hand columns should be 3 months ended, and the 2 right-hand 6 months.
Yeah, you sent me an email that a few minutes ago, which we've got, so thank you on that. We'll correct that.
I wanted to point that out. Second, what is the tax rate on the capital gain of the solar plant?
I wish you hadn't asked that question. It is lower than we'd expected.
But there is some tax. There is some tax, but it's not what we'd expected it to be. Okay, but not zero. I thought it might be. I thought it might be.
It's
I thought
not,
it might be zero.
no.
And finally, if you were to cut the dividend in the future, you could expect your stock to drop 20 or 25%. You have to ponder that.
Well, that's the point I was making.
Yeah.
Yes, and so and you don't know what the adverse effect will be until you've done it. By the time you've
Yeah.
done it, it's too late. I can think of some fairly salty sort of analogies which I use internally with the management team, which I can't use on this call, but it's one of those things you can't do without full and careful consideration. And frankly, even when you do it, you don't know where the outcome's going to take you.
You're in the great position of having future growth in Motapa or Bilboes, and producing gold at $3,300 or $3,400 generates a lot of cash inflow.
Correct. And so again,
it's a great position to be in.
And that's the point I was trying to make it earlier. I mean, what we're looking at now is how to make this project the best it can be, recognizing the fact the gold price is higher, therefore our organic cash generation is better, but also with an eye to the potential for near-term revenue opportunities, which are as yet indistinct but are coming into focus, which would further enhance that. And what we're trying to avoid is a situation where, we rush ahead and frankly over dilute, and then in 3 years' time we've said we've raised equity, which frankly we didn't need to do, because no one's going to thank us for that.
Agreed. All right, that's it for me. Thanks. Nice job, guys.
Thank you, Howard.
You're welcome.
Thank you, Howard. Just as a reminder to people, if you'd like to ask a question, please raise your hand. The next question is going to from Nick Dinham. Nick, please go ahead.
Come on, Nick, don't be shy.
You hear me?
Faintly.
Okay, I'll try to speak up here. Okay, thanks very much. Yeah, congrats, awesome. Just a couple of questions. You've been building stockpiles. I haven't yet got to the detail of what those stockpiles look like now, and it obviously underpins your production expectations. What is your stockpile strategy going forward?
Okay, then I think the stockpile is. I'm slightly irritated you're raising it, because it's about 30,000 ounces. So 30,000 tons. So if we're processing about 2,000 tons a day, it's 2 weeks. And a 2-week stockpile is even on the skinny side. So the fact that we're actually talking about having a stockpile of that size is a source of some embarrassment, and it kind of highlights where we're coming from. So the idea would be to build a stockpile in the ordinary course of events of up to 6 months, and then leave it. But there's no intention with the rate of blasting, tramming, and hoisting, if this is where you're going to go, isn't sufficiently above what we're currently processing to justify further investment to increase production. It's just ordinary course of business to have a stockpile.
Okay, thank you. And the other, you're obviously getting some surprises on the grade side. Maybe you can elaborate. Somebody can elaborate a little bit on that.
I think I'll probably hand that one over to Craig before I make a fool of myself. Craig?
Yeah, good afternoon, Nick. Yeah, so kind of the deeper we go on, some of the blanket ore bodies, specifically around BEQR and our old favorite Eroica, the grades that we are drilling out, and kind of remember that in 2023 we did our first real big resource update. So we may have been a little bit conservative on those grades because it was the first time that Caledonia was actually doing it. But we are finding that what's the term? That on the ground, the in situ grades tend to be a little bit higher. And so we've got quite a big drive on dilution controls, on mining guys have heard this before, on quality mining and things like that. So all of these things add up together and give us a bit of a grade sweetener.
Thank you. So when next you do your reserve estimate, which is going to be post the end of the year, we can maybe expect to see some grade improvements for the reserve as a whole. Is that where we're going with that, correct?
I don't think it's untoward to maybe see a slight uptick. It will, of course, depend on if we have mined all the high grade, then you've got no high grade left to raise the reserve grade. But I think it's going to be maintained or with a slight uptick.
Thanks. A last question or two here. It's back to Blanket. What dividends has Blanket produced in this period, in this first 6 months period?
Ooh, Ross, I guess, are you able to answer that?
So there was a 9 million dividend declared, but that included both the Caledonia side and the Blanket side. So yeah, there was a 10.7, so 7 net to Caledonia that came through after the NCIs or minority distributions.
So sorry, I didn't
So
get
it's just
the
over 10, just short of 11 million, or I think it was 10.6 million from a Blanket perspective.
From Blanket, 11 million came from Blanket.
Yeah.
Okay.
Yeah.
Okay. And then obviously linked to that question is the one I asked previously in the previous quarter. When will your NCRs be? Do you now think your NCRs will be fully repaid, fully drawn down?
Hopefully by the end of the year or very early in next year.
Okay. Right. Thank you. And then final question for Maurice. There's some discussion about alternative sources of energy. What are you thinking about, and how will this be? Will this be within, do you think, within the Blanket side of things, or do you think this will be Caledonia doing this?
Okay, can I intercede there? Our thinking's moved on. We took on a very good local chap to help on capital projects with enormous experience in the Zimbabwean power sector. And initially we were thinking about, solar's not great. I mean, solar's fine, but it only works when the sun shines. And really, you need a backup facility, which is pretty much the grid. Otherwise, you run the risk of losing production. So solar, I'm afraid, is not the answer. We were looking at other forms of captive power, but actually the solution we seem to have latched onto, we're doing further work on that, is to put in a connection to the 132 kV sort of backbone structure in Zimbabwe, which should substantially reduce which should improve the quality of the power that we're getting, and actually go a long way towards addressing some of the problems we've been facing. So at the moment, in terms of alternative sources of power, that's been overtaken by a proposal that we're working on now, which is to put in a sort of I think it's about a 17-kilometer, $10 million connection to the 132 kV backbone, which should materially address our problems.
Would that go in Caledonia? And would that go into Blanket accounts?
Yeah, because Blanket would benefit. Yeah, it's Blankets.
Okay. All right. Thank you very much.
Okay.
Can you just a reminder, if you'd like to ask a question, please do raise your hand. Next question is from Yun Lo. Yun, please go ahead.
Can you hear me?
Yep.
Very good. First of all, congratulations on a record-breaking quarter for breaking records. Question for James. James, or maybe for all of you, can you give us a steer as to how Q3 production is going to date, and in particular, are recoveries being maintained at around 94.5%?
Hold on, Johan, I've got to say you are naughty in that we've just upgraded our guidance to between whatever it is and whatever it is. So I mean, we've just told you what production is going to be for the rest of the year. So I don't know why you think we're going to give you a different answer from what we put in the press release 2 weeks ago. So having said that, James, what's your answer?
So production is going pretty good. I mean, for the third quarter, and we've got a very good metallurgical team. I mean, we are sticking to our guidance that we put out.
Okay, thank you for that one. Let's see, just going down the list of my questions. Nick has already asked several of them. Are you able to speak more? This is to Craig about the new discovery at Blanket. Is that the one at that? Is that another quartz reef, or is that disseminated reef?
Another disseminated reef. It's part of the Blanket ore body. So we have what we call Blanket 1, 2, 3, 4, 5, 6, and so now this one has been termed Blanket 7. So it's early days yet. It was a triangle of holes that picked up the zone that had good grades. So now obviously we've got to grow it and see where does it go. We've got to start pinning it out.
Okay, thank you very much. That's all my questions for today.
Thank you, Jan.
Thanks very much. We have no further questions at the moment. So what I'd like to do is pass back to Mark for any final and closing remarks.
Okay, well, good. Thank you all for joining us today. It's been a good performance from the entire team, and I thank them for that. And we look forward to doing it all again in mid-November. So thank you very much.
Thanks very much. That now concludes the webinar.